The market sell-off in 2026 has not been isolated to SaaS stocks. There's been a lot of growth stocks that have software involved, but aren't necessarily software as a service that have been caught up in this as well. So I want to go through 3 stocks that are down significantly that I think could be potentially good buys. Today I'm going to cover SoFi, Robinhood, and Coinbase. Their stocks are down 40%, 50%, and 60% respectively from their highs in 2025. But is this a time to buy, or is this a time to be worried? Because some things have changed for some of these companies. Let's dig into it. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. If you want more from me, including my stocks I buy every single month, check out my newsletter, Asymmetric Investing. There's a link on the screen and a link in the show notes. I also want to thank this video sponsor, Fiscal AI. I'm going to use Fiscal AI throughout this video, but this is the best fundamental research tool that's out there. You can get all the financials, of course, all the stock price information and charts. But the great thing is you can get all of the earnings information all in one place. I love looking through transcripts. Those are out just minutes after those calls are over. You can see exactly what management says. At the same time, you can look at their KPIs. How are they performing on those key performance indicators long-term? Just a phenomenal tool. I'm going to show you exactly how this works in this video. But if you want to try that for 2 weeks for free, go to fiscal.ai/ASYM. They'll also give you 15% off if you decide to become a like I am. First of all, let's start off with SoFi. Now, one of my theses behind SoFi is really, really simple. This is a bank that's just a digital bank. So you don't have a lot of the cost infrastructure that you have from traditional banks. I live in an area where I saw a bunch of bank branches going up, and you're looking at this going, okay, I'm using digital tools more and more. Why do we need more of these physical branches? This is just cost centers for these big banks. SoFi just doesn't have those cost centers. So that's got to give them a little bit of a leg up, you would think, long-term. And we're seeing that play out in the business. But you can see right now, shares are down 40% since their highs late in 2025. So just over the past few months, down about 40%. So what's going on with the business? And one of the things I like to do with SoFi is break it into their 3 segments that they report, and this is the revenue side. So in teal, you have lending, in orange is the technology platform business, and then in purple is financial services. Lending is going to be their traditional lending business. They started doing personal loans, and they moved into things like student loans, moving now more and more into traditional lending products like mortgages. But that's one of those businesses that takes a lot of capital. It really constrains the amount that you can grow. So what they've tried to do more is become more of a loan platform business. That's where they're offloading the risks and the actual loans themselves to investors who don't want to do the work of originating those loans. They just want to be able to collect interest. So they're going to borrow money or have investors that are looking for a specific rate of return. SoFi is going to provide the loans that provide that. But that loan platform business actually falls into financial services. It gets a little bit complicated, but you can see on the lending side of things, this is a steady growth business. Compound annual growth rate since mid-2022 is about 20%. And that's actually gone up a little bit over the past few quarters. One of the ways that they've been able to do that is they have raised a little bit of capital by selling some stock at a good stock price. But this is not necessarily going to be the huge revenue growth driver for SoFi. That's going to come more from the technology platform. So this is going to be where they're going to be able to be the technology behind other companies looking like they're offering financial services. So maybe it's a company where you get a debit card or a credit card, like a HSA, health savings account, something like that. That HSA is not necessarily going to do the administrative work of actually holding those assets and creating that debit card themselves. They're going to offload that onto a company like SoFi. There's also a savings account. So H&R Block, for example, they're going to essentially white label some of the products that SoFi is making. Not going to be quite as good at terms, but that's going to allow them to offer products. And then SoFi is the technology platform behind them. So this, again, growth business, but not a massive growth business, 15% compound annual growth rate. We'll see if this picks up over the next few quarters. They did have kind of some sluggish growth over until the past few quarters, but they won a few deals that should start to get a little bit more revenue. This is a pretty long sales cycle business, but again, it should be scalable like a lot of their businesses long-term. Once you build out that infrastructure, you build the technology and the digital tools, then you're able to sell it over and over again. Financial services has been the boon for the company over the past few years, growing as much as 100% year over year. The reason that they're able to do that is they're able to offer more of these services to their customers, in particular things like debit and credit cards. We're going to be collecting fees on an ongoing basis. Those fees aren't going to have the same risks as something like a loan, but it is going to be a traditional banking product. Like I said, this is also where the loan platform business revenue falls. So when they collect a little bit of revenue from that platform business for originating those loans, that revenue is going to fall into this financial services bucket. There's all kinds of other sales that they can do from their platform. If you put your money in SoFi, you're maybe using it for a savings account, maybe you're also using it for a little bit of investing, they're going to be able to sell you other products. Not all those products are going to be provided by SoFi. They're maybe just generating a fee. Those fees are going to fall into financial services. But overall, you can see this is a high growth business. Banks don't typically grow this quickly. The other thing that banks don't do is have a ton of operating leverage. And here's where I'm going to hide the revenue side and show the contribution profit for lending in green, technology platform in red, and yellow is financial services contribution profit. You can see that financial services wasn't actually profitable until the end of 2023, but since then you've had phenomenal operating leverage from the business. Going back to what I said earlier, this is the advantage of having a digital platform. To grow the business, you don't need to open a new branch in a new city. You don't need to hire a team of sales reps. You don't need to hire a bunch of people that are going to sit in the office and answer people's questions when they walk in. You just open up more digital products and reach customers at scale. That's exactly how SoFi is built. So we're seeing this play out in the business. Again, you're seeing compound annual growth rates in excess of 20%. In financial services has now gone from losing $191 million at the end of September 2022, that trailing 12-month period, to now nearly $800 million in contribution profit over the past year. So operationally, SoFi is moving in the right direction in a lot of different ways. Some of the things that we haven't even seen impact their income statement, their financials yet, is moving into cryptocurrency, the blockchain, stablecoins, some of the products that they're going to be able to offer there. They're one of the leaders, not necessarily on the bleeding edge, but they're definitely ahead of some of the bigger, more legacy banks and institutions. So I think that's going to be a help for them long term. And again, that's going to fall primarily in the financial services business. But is the stock a great buy today? If you look at their valuation, I think it's much more attractive than it was when shares were trading a little bit higher. If you look at just a trailing valuation, price to earnings multiple is about 51. Yes, that's expensive, but most banks aren't growing at 30%, which is what they're expecting for 2026. Price to book value, just 2.4. Banks typically trade for about 1 times book value. SoFi is going to be a little bit higher than that because they're not just a lending business, they're also a technology business. So you get a little bit more operating leverage. That's why I don't think that's a crazy multiple for them to be trading at. And you're looking on a forward basis, price to earnings multiple is just 29. I think for a company that's growing at 30%, getting a price to earnings multiple of 29, price to book multiple of just over 2, I think that's a really reasonable multiple. Now, $19.62 is what the shares are trading at as I'm recording. I would love to get them a little bit cheaper than that, but this is definitely one of the ones that I'm happy to own in the asymmetric portfolio. And it's on my short list to buy over the next few months because this is the kind of growth company that long term, they're going to keep compounding that revenue, that contribution profit. They're going to continue growing the business and they got that operating leverage kicking in. Everything is going the way you want it to for SoFi. It's just that valuation is extremely volatile. Probably got a little bit too highly valued in 2025. Now we're swinging the other direction. I'm happy to pick up shares under $20. If we go under 15, maybe even under 10, if things get really wild, that's how you get asymmetric returns, is buying phenomenal businesses for great prices. So yes, I think SoFi is a great buy today if you have a long enough time horizon. Robinhood shares are down 50% from their all-time high. This has been one of the biggest hits to the asymmetric portfolio because this was actually one of my biggest positions throughout most of 2025. And the drop has been incredibly rapid. You can see that in end of September, early October, that was when shares hit their peak and they're down a little over 50% since then. But what's going on in the business? Once again, I'm going to start with the revenue side of things. And what I want to show here, this goes all the way back to 2019. So before the pandemic, before Robinhood became really popular for trading, but look at how much more diverse the business is today. So in 2021, when things really peaked, they came public, you had $690 million worth of options revenue. Second thing was cryptocurrency revenue at 420. Then you had some equities revenue, and net interest revenue was its smallest segment. So a vast majority of the revenue came from very risky, very volatile kind of asset classes, options and cryptocurrencies. You look at the past 12 months, and options is still a big business, $1.1 billion worth of revenue. Crypto's also a big business, $901 million. But the biggest business is now net interest revenue. So this is going to be the kind of things like margin loans, fees that they're generating from credit cards, a lot more banking type services that they're going to be generating ongoing revenue from people having more assets on the platform. So it's not just transactions, not just options and cryptocurrencies, things like that. This is the maturation of the business. But let's look at this on a trailing 12-month basis because this does show what the trends are and what investors are worried about right now. And the big thing right now is the change in cryptocurrency revenue. I'm actually going to show this. Let me show this on a quarterly basis because I think this is a little bit more stark. If you go back to the December 2024 quarter, that was when you had a huge jump in cryptocurrency activity. That was around the election. Remember, when the election happened, the cryptocurrencies went absolutely crazy. That really helped Robinhood drive a significant amount of trading volume on the platform, $358 million in revenue just in that quarter. And most of that happened in the 2 months at the end of the quarter, but that's actually been in decline ever since then. So there was $221 million in cryptocurrency revenue in the most recent quarter. So there you can see high growth rate in Q4 2024. Comparisons were relatively low throughout 2025. And then you get to Q4 2025, that growth rate isn't quite what it was a year ago. So investors are going, look, is the growth rate slowing for Robinhood? In a way it is, because cryptocurrencies are not the tailwind that they once were. But let's take cryptocurrencies out of this. Let's take that one volatile asset class out of the mix, and you can see that the business is consistently growing, and actually the growth rate in the fourth quarter, excluding cryptocurrencies, is incredibly high, $610 million worth of revenue, up to $966 million worth of revenue. And these are the areas you want to see growth. You want to see growth in net interest revenue, in other transaction revenue. This is also going to include prediction markets. So we'll see where that goes in the future. Equities revenue and options revenue. All of these things are going to be much more sustainable than cryptocurrencies long-term, which can really ebb and flow what their trading volume looks like. Here's the other thing where there's good news long-term, but a little bit of volatility short-term. And that is total assets under custody continues to rise at an extremely rapid rate. Now $324 billion worth of assets under custody. This is all asset classes. But in the fourth quarter, that number came down a little bit. Why did it come down? Because some of those assets are going to be cryptocurrencies. Crypto had a really bad quarter in Q4, going to be probably a pretty bad quarter in Q1 as well. So again, that revenue from cryptocurrencies coming down, assets under custody coming down, that's going to be a little bit of a headwind for the business. So even if the business overall is doing well, crypto can be a headwind. The number of customers, this is funded customers, also not going up all that quickly. Only what a 200,000 person increase in the number of funded customers in the most recent quarter. This is, I think, the biggest flaw to me as an investor. I want to see this number be going up and to the right much more quickly. So Robinhood, you take a long-term view and things are absolutely going phenomenally well. Extremely high growth rate, in excess of 50% in a lot of their businesses. Price to earnings multiple, 37 on a trailing basis, 31 on a forward basis. That's not the cheapest stock in the market, but you're not going to get companies that are growing 50% or more for a really, really low price to earnings multiple. Price to book, 7.5. But here's the one that I always look at for Robinhood, price to sales multiple. And you can see that back in late 2023, that price to sales multiple was as low as about 4. Right now, that's up to 15. So multiple expansion has been a tailwind for investors over the past few years, but it has been a headwind recently. That price to sales multiple was over 30 in 2025. Where is the right number for Robinhood? Probably somewhere between 5 and 15 is probably a reasonable price to sales multiple given their current growth rate. So we're still pretty high on that end. Now, this is one of those stocks that I wouldn't be surprised if I add a little bit more in 2026, but I also wouldn't be surprised if shares fall. We're still at about $75 per share. That could definitely pull back. I think my cost basis is still in the 20s right now. Definitely don't want to buy it too high because you want to have because you don't want to have too much upside already priced into the stock. But it's hard to argue with what Robinhood is doing when you take a long-term view. This is another digital platform. They're reducing friction for investing. Some of the things that they're getting into, like prediction markets, yes, it's going to pull in people that are taking a little bit more risks, maybe a little bit more towards gambling than it is investing. But this is also the easiest place that I have ever seen to invest in something like a Roth 401k. This year, they're going to be introducing accounts for families, so custodial accounts. It's going to be much easier for my kids to be able to invest on Robinhood than it is on the current platform they're on using Charles Schwab. So if you take that long-term view, 5, 10, 20 years from now, Robinhood, I think, is very well positioned. Not quite a no-brainer price yet, not quite as cheap as we see with SoFi, but I do think we're getting there. And if shares fall a little bit more, this is one I'm going to be back in the truck on potentially in 2026. The stock down 60% is Coinbase, an early stock that I bought for asymmetric investing. I haven't actually bought much in the past few years, but we're now down to a $44 billion market cap, price to earnings multiple, about 35 on both a trailing and forward basis for Coinbase. Not going to be the cheapest stock in the market. And a lot of this decline in the stock is going to be because of the recent pullback in cryptocurrencies and crypto trading. So let's break down the trading for Coinbase, because this is still going to be the biggest single segment is transaction revenue for Coinbase. You can see that this was actually a vast majority of the revenue in 2021, 2022, $4 billion in revenue. This is consumer trading. Institutional trading has always been much, much lower revenue, much lower margin for Coinbase. But you can see this dropped off a rock into 2023. Then when crypto started to come back, you can see this spike again in 2024 and then pretty good year in 2025. And these are all trailing 12-month numbers. The problem is you get to Q4 and now we're not growing year over year, just barely growing transaction revenue from the fourth quarter of a year ago. So are we going to see conditions start to decline in 2026? That could absolutely be the case because crypto is down, Bitcoin's down. So it wouldn't be surprising to see Coinbase start to see transaction revenue move in that direction as well. But transaction-based revenue trading has never been the reason that I have been bullish on Coinbase as an investment. What I think this company is really about is disrupting the current financial ecosystem. This is everything from where you trade and own stocks to how money is moving from point A to point B. So payments Whether you keep money in a bank account or in stablecoins on a platform like Coinbase, how we're denoting asset ownership in different asset classes, all kinds of things that they can disrupt through the blockchain. And where you're going to see that revenue show up is in these segments: stablecoin revenue, blockchain revenue in orange, interest and finance fee income. They have custodial fee broken out for at least a few quarters back here, and then other subscription and services revenue. In total, I think it was 12 products that Coinbase has that generated over $100 million in revenue in 2025. And you can see that these are growing consistently, and they're now a huge business, $2.8 billion worth of revenue from non-transactions for Coinbase. This is ultimately what I'm the most bullish about. Now, $2.8 billion business, and we look at the market cap is $44 billion as I'm recording. That's still a really high valuation. But this is also an area where we are going to see likely high operating leverage for Coinbase. So if you're able to still grow these businesses at double digits, potentially even over 100% year over year, as we start to get more blockchain adoption in certain areas, this is where you start to see real upside for Coinbase. I think they're still just building that foundation, and investors still think of this as a crypto trading platform. Yes, that's a big piece of the business today, but the future for Coinbase is being much more of an AWS or an identity solution, something like signing in with Google. That's where their disruption ultimately comes from. Again, a little bit like Robinhood. This isn't a no-brainer price yet for Coinbase. So probably not back in the truck up at $165 a share. But if we start to get to $100 a share later in 2026, now you're starting to get to a really attractive price for Coinbase. This is one that I originally started buying in the $60 per share range. That was during the last crypto winter. That was before stablecoins became a really big business for Coinbase. But now we're starting to see these non-transaction revenues become a much bigger business. I think the lows are going to be much higher than they were in 2022 and 2023. So long-term, I'm absolutely bullish on SoFi, Robinhood, and Coinbase. I think from a valuation perspective, SoFi is definitely the most attractive, followed by Robinhood and then Coinbase, but all stocks that I want to own for the next 10, 20 years because I think they're in a disruptive position in financial markets. But let me know what you think in the comment section below. And don't forget to subscribe to Asymmetric Investing both here and on the newsletter. Thanks for watching, everybody. See you here next.